Is the stock market in a bubble here in March of 2021? In this video, we're going to find out. Let's get started. Hey there, this is Patrick King with Prana Wealth. On this channel, we help you build your wealth faster so you can make work optional sooner. So if you're new here, please consider subscribing. Over the last few months, markets have set new highs, even if they don't seem to make much sense. In talking with many people over the last few weeks, it seems that many intuitively and anecdotally agree with the idea that a K-shaped recovery has happened since the pandemic started a little over a year ago. There's also been a proliferation of stories in the financial media questioning the market highs and wondering if an impending crash is on the horizon. Is the stock market in a bubble? First, we need to define an asset bubble. A bubble happens when the price of an asset, stocks in this case, are bid up higher than the long-term sustainable value of those underlying assets would justify. Buyers continually bid up the price until, inevitably, the bubble bursts and prices return to reasonable levels. So is the market in bubble territory? There's no official measure or indicator that tells us definitively. However, there are a couple of markers that can give us the temperature in the room. First, we look at the Buffett indicator, which is the U.S. market cap, the value of all the U.S. stocks, versus the U.S. GDP, which is the value of goods and services produced in the U.S. Warren Buffett is purported to have said that this is the best, albeit imperfect, indicator of whether or not markets were overvalued. Often people link this indicator to his famous quote, "Be fearful when others are greedy, and greedy when others are fearful." If we examine the Buffett indicator, as shown in this graph, we can easily see that stocks are overvalued versus historical norms. In fact, the stock market, according to this measure, is more overvalued than during the dot-com bubble and just prior to the financial crisis. Now, that's saying quite something. There are others who argue that GDP, the denominator in this math equation, has been suppressed with COVID and expect things to normalize once the economy fully opens. But as the old proverb goes, there's many a slip twixt the cup and the lip. Exogenous factors could negatively impact future GDP growth, assuming that simple growth is enough in the first place. Another strain of COVID, surprise inflation, or geopolitical turmoil could all interrupt an extrapolated recovery. Another measure of the current investment environment is the level of margin debt. Margin debt is simply money that people have borrowed in order to invest. Typically, the more margin debt that exists, the more speculation, aka gambling, exists in the market. Adjusting for inflation, we can see in this graph that margin debt has grown to an unprecedented level. It's hard to say whether or not there was more speculation in markets in the 1920s, but there is certainly more than we've seen in the digital age. Also note the steep acceleration in margin debt over the last 6 months. Where else do you see that in this graph? You guessed it, 2000 and 2007. The confluence of working from home, low interest rates, stimulus, and easy access to trading platforms such as Robinhood have contributed to the resurrection of the day trader culture, reminiscent of the dot-com era. So what does this all mean? The combination of extremely high market valuations and record levels of speculation is cause for concern. There's a good case to be made that the market is a bit bubblicious at the moment.
Bubblicious has a brand new flavor.
Wow! New pineapple!
Bubblicious.
More often than not, asset bubbles go on for much longer than anyone expects, assuming that's what we're experiencing right now. Indeed, GDP growth may bring valuations back down from geosynchronous orbit. Many in the financial press point to pent-up demand and expected GDP growth as a case for markets going higher. They may be right. Although we can never predict the timing, there is one aspect of investing in which we can be certain. There will always be corrections in the future. By nature, bubbles pop. However, it's only in hindsight that the picture is clear and everything seems obvious. If you're concerned about how a stock market drop could affect your investments, then visit us at pranawealth.com to schedule a call. I'm happy to talk with you about how to prepare, and we do still have the capacity to bring on new clients. As a fee-only financial advisor in Atlanta, we can and do work virtually with clients all across the U.S. and we're here to help you whenever you're ready. Hey, if you found this video helpful, please help me grow my channel by liking this video and subscribing to my channel. Thank you so much for watching, and I'll see you soon.